Recession and crisis are the best times to get rich. It's not for nothing that they say the rich get richer and the poor get poorer during a recession. Do wealthy people know something we don't? That's exactly what we'll explore in today's video. Warren Buffett is currently the 5th richest person in the world with a fortune of over $100 billion. He's a billionaire and an absolute investment legend, with an average annual return on his portfolio of over 20%, while the S&P 500 index averages around 10.5% for the same period. I don't know a better person from whom we should take advice in this year, in the year 2023, and in the specific situation we have in the world now. And I'm referring to situations where stock markets fell by almost 20% last year. I'm referring to the situation where inflation is rising in America. And of course, I'm referring to the situation where interest rates are increasing, and especially in America, they will continue to rise. And at the end of the video, we'll also share a little gem that you probably didn't know about Buffett. It's his opinion on real estate. This will entertain you. We'll go through it, piece by piece, because when you understand the current situation and how to navigate it, you might make some money, because as Buffett himself said, bad news is the investor's best friend. Let's get into it. Hello, we are InvestGuide and welcome to another investment video. Interest rates are high. After a long period of several years with low interest rates in America, interest rates in America are relatively high. According to the local central bank, interest rates will even be increased. So how does the Fed invest in this environment?
Interest rates basically are to the value of assets what gravity is to matter, essentially. And if I could reduce gravity's pull by about 80%, I'd be in the Tokyo Olympics jumping.
It works exactly as Buffett says. Interest rates function like gravity on the stock market. When interest rates rise, the stock market declines, and vice versa. When interest rates fall, the stock market rises. It works very simply because when interest rates are low, people can borrow money cheaply with low interest rates and then spend more. Companies have higher profits, which in turn drive up stock prices. On the other hand, when interest rates are high, like they are now, people borrow less. You can see it with mortgages and loans, they don't flow as freely as they did last year. As a result, people spend less, companies have lower profits, and this reflects in the prices of their stocks. If you don't believe me, just look at this graph showing stock prices and interest rates. They move almost completely opposite to each other. As I said, you can see the last 10 years of low rates, and during that time, stocks grew. Now, you can't see it on the graph anymore, but you know that interest rates are currently high. And you know what the stock market is doing? It has been declining in the past year. Another thing you may not have known is that interest rates affect the yield on government bonds, which are generally considered the safest asset to invest in. You may wonder why. For a very simple reason, there's a very low chance that the government will not pay you back the interest and the principal amount you invested in those bonds. So when interest rates rise, the yields on these bonds also rise. A bond no longer offers, let's say, a yield of 0.5% but offers a yield of 3 or 4%. Currently, the yield on 10-year US government bonds is 3.6%, whereas in 2020, it was only 0.6%. Increasing interest rates in America multiplied this yield by 6. And now you're probably thinking, InvestGuide, why are you bothering me with boring bonds? I don't care about that. Just tell me which cryptocurrency will skyrocket next month. I want to get rich quickly. Just wait. This thing is important for your cryptocurrencies as well. When government bonds are attractive, like they are now, institutions, also known as big money, are either afraid or pulling their billions of dollars out of the market. That means they're investing that money elsewhere. Yes, you guessed it right. They're investing it in government bonds because why would they invest in stocks when the market is uncertain, volatile, and they don't know what's going to happen? They pull their money out of there and put it into very safe bonds. And this doesn't just apply to the stock market. When the stock market goes down, we see some correlation with cryptocurrencies, such as Bitcoin. So what should we take from all of this? What does Buffett actually advise in these situations? We must realize that we don't have absolute control over what the US central bank will do. But we do have control over what we invest in, what we buy, whether we buy quality, defensive stocks, growth stocks, and when we should buy them. And whether we even invest when interest rates are high, like they are now. Because guess what? Interest rates will eventually be almost back to zero, as it has been several times in history. And of course, when interest rates are back to zero, stocks will benefit from it. So logically, you want to buy when interest rates are high because they will eventually be low again, and the market will benefit from it. You, as investors, will benefit from it because now you know how these things work. And if Buffett doesn't convince you to invest, maybe a free stock from the investment app Trading 212 will help you. So if you want to get something for free, why not a stock? Just register through the link in the description, deposit some money into your newly created investment account, and voila! Within 3 days, you'll receive a free stock worth up to $100 that you can do whatever you want with. If we look at the Berkshire Hathaway stock, ticker symbol BRK, on the platform, precisely from Buffett, you can see the beautiful long-term growth over the past 5 years and more. In the last 5 years, BRK has gone up by 52%. But you can also see that BRK, just like any other stock, has experienced declines over time, including the one it went through last year. So what does Buffett advise us to focus on during market declines?
A little bit about the fact that the market's down almost 800 points this morning.
Yeah.
Concern for you?
Well, no, that's good for us, actually. We're a net buyer of stocks over time. And just like being a net buyer of food, I expect to buy food the rest of my life, and I hope that food goes down in price tomorrow. When stocks are down, we're going to be buying on balance. And who wouldn't rather buy it, at a lower price than a higher price? People are really strange on that. Most people, most of your listeners are savers. And that means they'll be net buyers, and they should want the stock market to go down. They should want to buy at a lower price. And they got that feeling that they just feel better when stocks are going up.
On this example, you can beautifully see how the Buffett thinks. If you're under 50 years old, you should probably be almost happy that stocks are declining if, of course, you want to invest. Because even though the prices of assets can fluctuate and fall in the short term, they generally grow in the long term, whether they are stocks, bonds, gold, or real estate. Of course, each asset behaves slightly differently, but in the long run, these assets grow. The only thing that doesn't grow is the purchasing power of the dollar. Currencies have lower value due to inflation, which reduces their purchasing power and devalues them. Long-term investment is precisely for this purpose. Another thing Buffett mentions is that people generally prefer to buy when stocks are rising. The psychology here is actually completely opposite. Most people like to buy things on sale, right? But when it comes to the stock market, when they buy and invest in stocks, for some reason, people just prefer to buy when the stock has been rising for several months in a row, when it's in a bubble, when it's at its peak. And conversely, when stocks have been declining for several months in a row, as was basically the case last year, people stay away. Hey, I'd rather wait. The psychology is actually completely reversed when it comes to investing and buying things on sale. It's strange how this can be observed, and it's certainly not the right approach. Anyway, now you already know how to do it right?
People should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock?
Yeah, selling a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along next day and says, "I'll pay you 15," you don't sell it because the quote's 15. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business.
Let's talk about high inflation. How did Buffett historically invest during such times?
Businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth and that have strong positions that allow them to increase prices with inflation.
Maybe you weren't interested in what Buffett said, but in fact, it was the most interesting and important thing that was said in this video. In times of high inflation, businesses that have low operating costs and don't require a lot of investment, including external investments for their growth, tend to thrive. Buffett actually outlined a few rules on how he specifically invests. He actually wrote down these principles in 1982, during a period of high inflation, which we are currently experiencing, and they still hold true. The first rule is that businesses are able to increase the prices of their products and services even during times of high inflation, without losing customers. Let's give an example. By the way, it's actually called pricing power. Here's an example. I recently went to buy a Coca-Cola, and I remember the times when a can used to cost 50 cents. When I went recently, that Coca-Cola was priced at $1 or $2. And guess what? I still bought that Coke because I like it and I've been drinking it for decades, and I guess 99% of you will still buy that Coke too. That's precisely the ability to raise prices even during a year of high inflation. That's pricing power, and Coca-Cola has it. The second rule is to look at businesses that don't require external investments for their growth. Let's explain. If we look at companies like Google or Facebook, they don't cost much to attract your eyeballs, as they constantly display advertisements, which of course brings them the most money. On the other hand, you have Amazon, which has hundreds of thousands or even more than 1 million employees, warehouses, robots, and vehicles. Basically, it incurs a ton of costs just to make any money at all. Facebook and Google are ideal businesses for times of high inflation because they don't require much to make a profit. Amazon, on the other hand, is heavily affected by inflation because it has enormous expenses to earn any money. That's why Amazon is impacted by inflation many times more than, for example, Facebook or Google. And of course, these were just examples, but you can apply these practices and principles to any business. Therefore, pay attention to the ability of the business you're investing in to raise prices. See if your business has pricing power, and keep an eye on its margins and costs. Now let's move on from stocks to real estate and discuss why Buffett doesn't like to invest in real estate. Why does he think that real estate is not actually a good investment?
We've both had a fair amount of experience in real estate, and Charlie made his early money in real estate. Under most conditions, it's hard to find real estate that's really mispriced.
By its nature, real estate tends to be a very lousy investment.
I looked into it. I read several articles and watched videos, and Buffett actually explains that he can very simply calculate the future cash flow of a company, how much that company will earn, but he can't do that with real estate. He also believes that real estate doesn't change hands as frequently as stocks. Undervalued properties are not sold as often below their market value, as stocks are. And lastly, Buffett doesn't like dealing with rentals. According to him, it involves much more work compared to investing in a good business that pays you dividends because dividends require less effort. I think the conclusion is that everyone has their own preferences, everyone likes something. Some people are real estate investors or invest in gold, they understand it, can generate returns from it, while others simply love stocks. It's clear that Buffett loves stocks. He may not be as interested in real estate, Bitcoin, or cryptocurrencies, and I think that's perfectly fine because not everyone can understand everything. The main thing is that you understand at least something. And if you would like to learn more about investing, I'll be looking forward to seeing you on my Patreon in our investor community. And if you're interested in my experiences in 8 years of investing, take a look at this video. Take care.